On behalf of our team at HBK, I would like to welcome you to Market Update and Impact on Manufacturers' Retirement Plans with HBK Manufacturing Solutions, Amy Reinalt with special guests from HBKS Wealth Advisors, Brian Sommers and Rod Diaz. Our session is scheduled for 60 minutes and is being recorded. A copy of the presentation materials is available for download in the handout section of the GoToWebinar control bar. At the end of the session, you'll be prompted to complete a survey and provide us with feedback on the presentation. For more information and insights, please visit our manufacturing section of our insights page at hbkcpa.com/insights. At this time, I'd like to turn it over to Amy.
Thank you so much, Michelle, and good morning and welcome to all of our attendees today. My name is Amy Reinalt, and I am a manager with HBK Manufacturing Solutions in our Canfield, Ohio office. Today, we are really excited to start our second year of manufacturing webinars with today's presentation. We've had some really great topics over the last year, from cybersecurity to strategic planning, COVID-19 relief options to tax planning, insurance, as well as recruiting and retaining employees. Today is our 13th webinar, and we're going to talk about the economy. The past year with the pandemic has really affected us all in many different ways. And while we've gone through the pandemic, we've also endured many fluctuations in the stock market. Today, as Michelle mentioned, we have two special guests with us, both from HBKS Wealth Advisors, one of our affiliated companies to HBK CPAs and Consultants. HBKS Wealth Advisors has over 90 team members, 12 offices in 4 states, Ohio, Pennsylvania, New York, and Florida, and over 5.5 billion assets under management. Our teams at HBK CPAs and Consultants and HBKS Wealth Advisors work together really closely, so obviously today is no different. From HBKS Wealth Advisors, we have two special guests. First, Brian Sommers, who is a Principal and Chief Investment Officer, as well as Rod Diaz, who is our Retirement Plan Manager. Brian and Rod are going to be talking to provide us with a market update and also talk about an overview of retirement plan considerations that all businesses and especially manufacturers with those retirement plans should understand. As Michelle mentioned, this webinar was actually pre-recorded for today's August 18th webinar, so if you have some questions, we will not be answering those live. However, if you do have questions, concerns, comments, or so forth, please don't hesitate to contact Brian or Rod. Their contact information will be shown at the end of the presentation. And of course, you're welcome to contact Jim DeCenzo, our National Director of HBK Manufacturing Solutions, or me. We're all really happy to help. With that being said, I'm going to turn the floor over to Brian Sommers.
Thank you very much, Amy, and good morning, everyone. So today I'd like to talk about the state of the economic recovery and what we see in the stock market and in the fixed income markets for the rest of this year and into next year. So on the first slide, the global economy has made enormous progress, rebounding from the depths of the lockdowns, but we still have a long way to go to regain all of the growth that was lost during the lockdowns because of the pandemic. And so as we move into the latter part of the year, the economic data, which was indicating strong growth across the board until very recently, has recently become more mixed. On the positive side, 2/3 of all adults are fully vaccinated in the United States. And more importantly, fatalities and intensive care hospitalizations remain very low in most places in the country, despite the emergence of the Delta variant of the COVID virus. And because of this, the reopening of the businesses and business activity has accelerated the last few months. Many offices are welcoming workers as well as clients back to the office. And there's been a surge of activity in the services sector in particular, because people have plenty of cash in their pockets, thanks to the stimulus checks, and credit conditions are favorable as well. People are traveling again, and many restaurants and hotels are often filled. We have on this chart here some of the high frequency data, which is the data that comes out very quickly as far as activity in specific industries. And so what you can see here is on each one of these charts, the gray line is the activity during 2019, or the year before the pandemic. The yellow line is activity last year during the pandemic. And then the dark blue line is activity this year so far. And pretty much across the board, whether we're talking about box office receipts, hotel occupancy, restaurants, commercial flights, you can see that the dark blue line indicating activity this year is definitely higher than it was during the pandemic, but not quite where it was pre-pandemic. And so, what this would tell us is that while activity in all of these sectors is now rebounding and expanding, it still is not back to the levels that it was before the pandemic. We still have a ways to go. But it is encouraging that a lot of the activity is returning. And so as a result, the job market is recovering, and manufacturing data remains strong in the United States and most of the developed world. On the next chart, you can see that still there remain many obstacles to a full recovery. First and foremost, as I mentioned at the beginning, the emergence of the Delta variant is causing some businesses and governments to require masks indoors again. Right whenever businesses are attempting to get back to operating at full capacity, and they were already dealing with supply chain disruptions and worker shortages, and now they might have to face the possibility of people being cautious going out in public again, or possibly even business shutdowns again, which could short circuit the recovery. What I have listed here is the manufacturing data, and whether it's new orders, production, prices, imports. If you look down the direction column, manufacturing is still growing. However, the rate of change is slower in most of those categories. And for the overall manufacturing PMI, it is growing, but it is slowing. Consumer demand is still growing as well, but that growth rate has slowed since the initial surge as well. And we can see that on the next chart. Part of the reason that the growth rate in the economy is beginning to slow is the increase in spending on services is being partially offset by declining spending on durable goods. What we have here is, you can see the chart, the blue line is spending on durable goods, and the yellow line is spending on services. And whenever the lockdowns occurred right at the start of the pandemic, both of those categories fell off dramatically. And then as we moved into the middle part of the year, thanks to the stimulus and some of the government spending and the checks that went out to people, both categories rebounded. But you can see that the spending on durable goods rebounded much stronger than services. However, what's happened since then, towards the latter half of last year, and then as everything has recovered this year, the spending on durable goods has is basically falling off. You can see that it's been somewhat volatile, but it's still trending downward, while spending on services has essentially flatlined. More recently, those numbers have turned up a little bit, so it is recovering. But as you look at the most recent numbers, spending on services is increasing, is positive, while spending on durable goods is negative. And so what we see the rest of the year is that households are likely to continue spending on services that they missed during the pandemic. However, this will be at the expense of spending on the big ticket items like cars, appliances, furniture, and other big ticket items which comprise that durable goods. And whenever the stimulus checks and the extra unemployment benefits stop in the fall, it's possible that consumer spending on all goods and services may slow. Another factor is that the world's central banks have begun the process of reducing the monetary stimulus put in place during the lockdowns. Now, while the level of liquidity in the economy is still high, it is beginning to fall as many of the central banks around the world are beginning to remove the stimulus. So the boost that it has been providing to the economy will be smaller going forward. So all of these reasons are why we believe that we may have already experienced the peak in growth rates for the recovery. So let's take a look now, beginning on the next slide, with what that means for both the labor market and inflation. So first, let's look at the labor market. In the labor market right now, there is an unusual situation of a worker shortage in some sectors, while at the same time, there are many job openings in other sectors. And it's very unusual to have an elevated unemployment rate along with a large number of job openings. Yet in July, the job openings and labor turnover survey, or JOLT survey, showed that there are 10 million job openings, while at the same time there are almost 9 million people unemployed, which again, that's a very unusual situation to have both of those numbers being very large. You can look at the chart and see that it's not often that both of those numbers are elevated. And there's many reasons that have been cited for this. In many cases, the skills of the job seekers are not compatible with the skills that are required for the jobs that are available. Also, some people are hesitant to return to their jobs, particularly in service positions, with the pandemic not fully over. And there are also reports of many parents who can't find adequate daycare, which would enable them to go back to work. And then still others don't feel the need to return to work if the federal government is sending out stimulus checks. In fact, some studies have shown that there are some people actually have a higher net income staying home and collecting unemployment and the stimulus checks, as opposed to going to work and paying for commuting and childcare. And so this mismatch that we have should most likely disappear in the fall as the pandemic fades and as the higher unemployment benefits fade away, as the checks stop coming, and by then employers will likely be more agreeable to more flexible schedules and higher pay to recruit new employees. And the thought is that this, along with the end of the stimulus checks, should bring people back into the workforce and once again drive the unemployment rate lower. Now on to inflation. So inflationary pressures were being caused earlier in the year by some short-term issues related to restarting the economy. Restarting business activity created several issues that companies have had to deal with, which is driving their input costs higher, such as supply chain disruptions, higher raw material costs, constraints related to shipping products, and a tightening labor market. These upward price pressures are most likely going to prove to be temporary as we move into the latter half of the year and into next year. And the thought is that they were, the higher prices that we're seeing are a temporary repricing of goods whose price was artificially depressed because of the lockdowns. When businesses adjust to the post-pandemic growth surge, a lot of these issues will go away or at least become less of an issue. And these inflationary forces should ease and prices should stabilize, although at higher levels than they were previously. An important thing to remember is that the stimulus checks are temporary payments and not an increase in the annual income of consumers. So by definition, they will only provide a short-term boost to spending. And it's likely that once they stop, the spending will continue to slow as well. Also, the Federal Reserve has indicated that they're going to start tapering their bond purchases soon. Some of the rumors out there are that they're going to announce in September the timing of that tapering. But it's possible that it's going to be before the end of this year, or if not, early next year. So the Fed's economic stimulus is going to be lessened, fairly soon. The infrastructure proposal that was just passed, or the infrastructure bill that was just passed, will provide almost $1 trillion in spending. And then President Biden has proposed that he's going to get an additional $3.5 trillion in spending on infrastructure passed. Although there's a lot of resistance to a bill of that size, even within the Democratic Party. So depending on what bill ultimately gets passed, it could end up providing only a small boost to economic growth. So next year, when the economy is fully open, a lot of these forces that we're talking about will be in the past. And the economic forces that have kept inflation in check for years, such as global competition, improvements in technology, and just-in-time inventory management, all will still be in place and will likely keep inflation in check once again. And then on the next page, you can see that already prices in some closely watched categories, such as lumber and used autos, have already begun to fall. These charts show that lumber prices have already begun to fall. And then at least one measure of used car prices, the Manheim Used Car Vehicle Index, has already begun to fall. Now, the CPI report for the month of July that was just announced this week announced that core inflation rose less than expected, and the prices in the transportation services category fell. It did indicate that used car prices and prices in another key category, apparel, was actually flat. It didn't fall, but it was flat. But either way, it does appear that a lot of these inflationary pressures are beginning to wane as we move into the latter half of the year. And then on the next chart, I want to make the point that the world may be entering a period similar to what Japan experienced for the past 30 years. These charts show that beginning really in the early 80s, so over the last almost 40 years, in Japan, federal government spending has skyrocketed, and so the government debt as a share of total GDP has skyrocketed from down around 40% of GDP in the early 80s up to over 200% at the beginning of last year, and then it skyrocketed again due to the pandemic up to almost 240% of GDP. And all during that time, on the right-hand side, you can see that inflation in Japan really went nowhere. While there were some temporary periods of spikes in inflation, it always would then, within a year or two, fall back toward zero. And now there were some other reasons for that, specific to Japan, such as, in addition to some of the categories or the factors that I mentioned earlier, there also was an aging demographic issue in Japan. However, if you look in the rest of the developed world, it is also now developing an aging issue in the rest of the developed world. So it's quite possible that if we look over the next 20 to 30 years, the rest of the developed world could be in a similar scenario that Japan was in for the last 30 years. Another factor is that was true in Japan and now is going to be true going forward is that as the debt skyrocketed, a lot of the spending that previously would have gone to spurring growth now has to go to just service the increase in debt. And again, that is going to steal growth and could cause the level of growth and the level of inflation to remain very low going forward. So I know a lot of people are nervous about the government spending creating an inflationary environment. And I'm at this point, I'm not that concerned about it. I'm actually more concerned about it creating an environment where there is a very slow growth and slow inflationary environment over the next foreseeable future. So that is what I see in the overall economy. So let's talk a little bit about what we see in the equity markets first. So as everyone knows, prices have surged in the stock market after the market sell-off in March of last year in anticipation of an earnings recovery. After we had the initial stages of the lockdown last year, people began anticipating the earnings recovery that would come as economic activity recovered. And that pushed valuation levels much higher than their historical averages. As of this morning, whenever I'm doing this presentation, the MSCI All Country World Index, which is an index of global stocks, is 30% higher, and the S&P 500 index is 35% higher than it was at the pre-pandemic market peak in February of 2020. However, as we show here, real gross domestic product, or real GDP, is still 2.6% below real potential GDP, and also below where we likely would have been if the previous trend would have continued. And so the strong earnings growth that companies have had have been reporting this year was needed just to justify the current level of most stocks. Just this year, the S&P 500 index is up another 20% since the beginning of this year, and yet, as this shows, we're still below, where GDP would have been based upon current or previous trends. And so, whenever we had a period like this, where the S&P is taken off in anticipation of earnings, we need earnings to continue their strong growth just to justify current valuations, because it appears that stocks may have gotten ahead of themselves. and that we get that indication that stocks have gotten ahead of themselves by looking at the next chart as well. This chart is a chart of the market's 12-month forward price to earnings ratio, which is the red line, versus the 12-month trailing PE ratio or price to earnings ratio, which is the blue line. And if you look at this over the last, say, 15 years, the trailing PE for the S&P 500 index usually moves in tandem with the forward PE. And anytime that you can see a gap begin to form, that gap typically then narrows again, within the next couple years. What we've seen over the last year has been that the gap between the trailing PE and the forward PE has gotten much larger than it ever has. And this is because prices have moved much more quickly than corporate earnings have recovered. And so, what we need to have happen is that corporate earnings need to grow very strong, continuing over the next 12 months in order to justify the current valuations. Or the prices need to come down in order to match current earnings. And so what we believe is that although corporate earnings should continue to grow, we believe that if economic growth slows as we anticipate, then that will slow the rise in stock prices, and we may need to have a pause in stock prices or even a short-term downturn in order for that gap to narrow. So the good news is that corporate profits in all sectors of the economy are reporting very strong quarterly earnings. So we don't see a sell-off happening anytime soon, but it does indicate that returns in the stock market going forward is going to be much lower than they have been to this point of the economic recovery. On the next chart, it does show that, even though I'm saying that we have seen the peak in growth rates and we're likely to, over the next 6 to 12 months, continue to see the recovery in growth, but at lower growth rates than we've seen up to this point. The good news is that the market has historically been able to continue to eke out gains, even as the growth rate is slowing, although the returns in the stock market have been much less. So what we're showing here is the S&P 500's average monthly rate of return during various economic cycles. And so the first bar shows that whenever the ISM manufacturing index is going from its trough to 50, which essentially means that it's improving but still contracting, average monthly returns are about 1.56%. Whenever we get into whenever it is from 50 up to its peak, or it's expanding and still improving, returns are also strong, about the same, about 1.56%. However, when the ISM index is still in expansionary territory, but slowing, which is the blue bar, returns are positive, but less than half of what they are when ISM is improving. So once again, this tells the same story that stocks are still have a high probability of moving higher over the next 6 months or so of the recovery, but returns are going to be a lot less than they have been for up to this point in the recovery. And it's another indication that returns are likely to be more modest over the next year. Another thing is that the growth in earnings is up 84% for the second half of the year. However, companies that have beat on both earnings and revenue have seen their stock prices barely budge after they announce their earnings. And again, there's a couple of reasons for that. And one of the reasons is that most companies are giving very cautious guidance going forward because they also believe that growth is going to slow. But then it also is an indication that, as I've been saying, is that stocks have already reflected the strong corporate earnings growth in their current valuations, and we're going to need to continue to see those strong earnings in order for stocks to continue moving higher. And then finally, weaker growth could also determine which sectors lead the stock market higher. And leadership may shift again as the economic cycle matures. We have seen over the last year this push and pull between growth and value. And what we have seen is that every time economic growth is accelerating during the recovery, those value stocks that are most leveraged to the economic recovery, financials, industrials, and energy, have led the market higher. However, whenever we got into a period where growth appeared to be slowing and appeared we were in peak growth, then the growth stocks then assumed leadership because investors were paying up for persistent earnings growth. And so those stocks, particularly in the technology sector and other large cap growth stocks, outperform as people are looking for the scarcity of growth. And so we've already seen that happen really over the last month and a half. After 9 straight months of financials and industrials and energy, the value stocks outperforming, over the last month and a half, we've seen growth reassert itself as more people are coming to the conclusion that we have seen the peak in the growth rates. And so the thought is that is likely to continue if the scenario we're talking about actually happens. And then on the next chart, I'd like to just finish, before we get on to the best practices, I'll just finish with the fixed income markets and just talk real briefly about what we see going on in the fixed income markets. Currently, we're in a situation where bonds had been rallying and yields had been falling until very recently, once again, after rising earlier in the year when inflationary expectations were at their highest. And the yield on the US 10-year Treasury went as high as 1.75% in late March, but is now hovering right around 1.3%. So again, this peak inflation and peak growth themes is the main reason that rates are beginning to rise once again. The Fed has remained very consistent in their messaging around expectations that inflationary pressures are going to be transitory, and we believe that they were right. So we think that yields are unlikely to fall much further, but if growth does stay more moderate and the Fed is true to their word and they don't hike rates this year or next year, remember the Fed is saying they're not going to hike rates until 2023, then we believe that yields are going to remain in a very tight range, which is a bit higher than they have been previously, but still in a tight range. And so the prices in the bond market are likely just to tread water and again, eke out very modest returns over the next 12 months. And so that's all I have on the fixed income market. So now we could move into the best practices for plan sponsors and Rod Diaz. Go ahead, Rod.
Thank you very much, Brian. I appreciate it. And thank you, Amy, for having us as part of the Manufacturing Solutions Group's webinars. They're so informative. What I'd like to do today is review with you 10 areas where you as a manufacturer who has a retirement plan or a manufacturer that is considering having a retirement plan can make improvements, significant improvements in that retirement plan. And these 10 suggestions, these 10 best practices come from the retirement plan unit here at HBKS, working with many of our clients. These are the top things that we tend to find where we can bring some improvement to the plans. So without further ado, let me get into this so I don't consume too much time. Our first recommendation is for you to consider open architecture platforms. What do we mean by that? The platform is the record-keeping platform on which your retirement plan runs. It's essentially the chassis that is responsible for the abilities and limitations of your retirement plan. And so we're recommending that you have a retirement plan that has open architecture. Open architecture means it has access to many different investments, many different mutual funds, collective investment trusts, et cetera. We all want to have very good investments in our retirement plan, of course. And if we are bounded by our platform provider, say we go to a bank or an insurance company or another financial services firm that offers us a retirement plan, but we are only able to use their investments, well, we have a smaller universe to choose from, and we run the risk of not being able to have best-in-class investments in our retirement plan, and that would be no good. So if we want to have great investments, and I think we all do, we would need to consider an open architecture platform for our record-keeping solution. So that's topic number one. Number two, we urge you to examine your plan fees. I hate to say this, but most plan sponsors don't know what their fees are even, and it's not their fault. These fees in many times are kind of hidden, and so you need somebody like a financial advisor who can kind of dig through and help expose what the fees are. The Department of Labor requires, actually through ERISA, which are the laws that govern retirement plans, that plan sponsors offer a retirement plan with reasonable costs. And if you don't know what your costs are, how could you possibly know if they're reasonable? So we definitely encourage everybody to ask, if you don't know what the fees in your plan are, to make sure you understand the different components of the fees. There's investment fees, there's advisor fees, there's record-keeping fees, there's third-party administrative fees. There could possibly even be an audit fee. You need to know what the breakdown of those different fees are, and then most importantly, once you know what those fees are, they should be benchmarked against other plans of similar size, be it by assets or by employees, or plans that are in your same similar industry. And so when you get that done, that's called the benchmarking fee study, you will know how your fees stand vis-a-vis those other retirement plans. So a very important thing for all plan sponsors to know their fees and understand their fees. And certainly you can get help in order to do that. If at the end of this presentation you want to send in a comment and you need help understanding what your fees are, we can help you with that. In the next slide, please. We had talked about wanting the best investments, and that's definitely critical. Everybody wants to have the best investment. Brian just covered the economy. We've got new knowledge. Now we want to go put that knowledge to use. We want to make sure we're choosing the best investments that are going to reflect the future economic impact that's coming our way. So we want to have good investments, but we cannot have good investments unless we are monitoring them closely. And this is another actually responsibility that a plan sponsor has. It's in the Department of Labor rules, it's in ERISA, that there has to be a procedural process. There has to be a prudent procedural process, which is documented and demonstrated that on a regular basis, they don't mention what regular means, but we take that to mean at least once a year, you sit down with somebody and you review these investment options. What does an investment monitoring look like? If we could have the next slide, please. what you can use is an analytical tool that would basically look at these the investments that are within your retirement plan and compare them against other investment options. And so this is an analytical tool. There are many out there to choose from. This happens to be FI 360, which is very popular. And what it tells you is how your investment does. And this is a Northern small cap value. So it compares Northern versus other small cap values in the same asset class, sub asset class, if you will. And it says, how is this fund performing, in terms of return, in terms of risk, in terms of expenses, compared to other investments. So you need to have this type of demonstrated analysis done so that you can have it in your files, and if your plan is ever audited, you can evidence the fact that you have been reviewing the investment options. So very, very important to, on a consistent basis, be monitoring your investment options. It also obviously helps to have an investment policy in place, which is sort of the gold standard. It's the standard with which these investments are compared to. So definitely part and parcel of monitoring the investments is having an investment policy statement. Next slide, please. Okay, so best practice number 4 is to track the timeliness of participant deferrals. We're only mentioning this really because lately the Department of Labor has kind of made it a little bit of a witch hunt. They've decided that they're going to camp out on this topic and penalize people who don't do this. And what we're encouraging you all to do is, as employers, is to ensure that the monies that are part of the salary deferral of your employees be sent to your record keeper, be sent to your trustee of your plan on a timely basis. Many people out there believe that you have 15 days to make these deposits. That's not true. If you're a large employer, more than 100 employees, chances are they're going to give you 2 days to get that deposit done. And if you've demonstrated in the past that you're able to, on your payroll date, submit your 401k contributions, then they're going to expect that standard. So whatever has been your standard up to date, if you can do it same day, that's what the Department of Labor is expecting you to do same day. So we don't want to have any late deposits of employee salary deferrals into the 401k trust because it can get us into trouble. And to that point, next slide, please, Michelle, is I just want to share this with you. This disturbing fact is that just last year alone, the Department of Labor raised over $3 billion in fines against employers who had retirement plan infractions. And the majority of these were due to late deferral deposits into the 401k trust. So we definitely want to avoid that. It's certainly one of the best practices that you'll want to consider when doing this. Now, most of our employers don't have that problem, but you want to be sure that that's not happening at your shop. So please be cognizant of that. Fifth point and fifth best practice is to review your plan design periodically. Could be once a year, could be every 3 years, but plan design changes over time. The laws have been tweaked and rewritten, and there's many opportunities within the new sets of laws, whether it's SECURE or the CARES Act, to improve current retirement plans. So if you set up a plan 10, 15, 20 years ago, and you really haven't revisited the plan design, you may want to do so because many things have happened over those years that make the plan better for your employees and possibly even better for you as employers. Among them are Roth deferrals. Does your plan currently offer Roth deferrals? The other thing is, have you been doing a match all this time? Are you better off with a safe harbor or a safe harbor match? These are things that need to be considered to make sure that your plan is optimized for the current conditions. Also, another thing that we see that's very prevalent in the industry is that maybe you or your plan has a profit sharing contribution, and we see that people tend to, employers that have had a profit sharing for a long time, don't realize that their profit sharing doesn't have to be pro rata, which means that if the higher paid employees get 3% of salary, then the lower paid employees have to get 3% of salary. Everybody does not have to get the same percentage. There are newer methods that allow you to move those percentages around. They could be done by age. It could be integrated with Social Security, and we even have a new design type called new comparability, where you can either create asset employee groups or even individual employees can receive higher compensation, a higher percentage of profit sharing than other employees, and so you have the ability to kind of make some very flexible decisions in terms of profit sharing. So be sure that you're using the most up-to-date design features for your retirement plan. Next slide, please. Speaking of advanced design solutions, another thing that you may want to consider is a cash balance plan, adding a cash balance plan to your 401k. If you currently have a 401k, it's working very well, but possibly as owners of the business, you want to defer even more than the statutory maximum of $56,000. You can look at a cash balance plan. Even if you don't implement it, it's worth doing the exercise of considering it. Cash balance plan basically puts a modern pension plan alongside the 401k plan and allows us to get more dollars into usually the higher paid, more senior members of the company to a very large degree. So it's a very intricate design. Third-party administrator is required for this, but it does maximize tax savings, which in today's world are very much appreciated. Michelle, if you could show us the next slide, here's an example of what a cash balance plan can do. I know that this is a busy slide, probably having trouble focusing on all these numbers. So to that, I've basically highlighted one number, which is the allocation here to one of the partner owners in the retirement plan. This is an actual live case of an actual live client that we did. You can see they have basically $1.7 million in compensation. That's the total salary for this company. The partner number one wants to retire, and so we found a way to get $212,000 into his cash balance account, and then we had an obligation to pay the employees, right? It has to be fair. And so you can see that we did have to make a pretty minimal payment of 2% of salary to the non-highly compensated employees. So in the cash balance that we're showing here, a total of $237,000 went into the cash balance, and 76% of that, or $212,000, was able to be directed to the owner in this case. And this is going to allow the owner to basically transition out of the business and leave the business to the following, to the successor employees, so that they can take over the business. So this is a very aggressive design that allows for maximum tax deferral, especially in situations of business transitions. Great tool to use. And again, if you end up not using it, it's definitely worth the effort to at least consider it and to have a design done. And these designs can be done free of charge through our TPA partners, who can actually do the analysis to see how much we can defer from taxes. Okay, next slide, please. All right, consider outsourcing your fiduciary liability. Again, over time, there's been some improvements in our regulatory environment, and one of these has been to make better use of what is known as ERISA 321 or ERISA 338 or even ERISA 316. These are all statutes within the law that basically define the fiduciary duty. And what these have done is that they've allowed employers like yourselves to delegate, if you will, some of the investment responsibility. A 321 advisor, you'll normally find this associated with the financial advisors that help you with your retirement plan, is somebody who basically can recommend investments to you as an employer, as a sponsor, and you accept those recommendations, and therefore you're in some regards, removed of the liability of having to search for investments. Furthermore, if you choose a 338 advisor, that advisor takes on discretion of actually choosing these investments for you. And so it absolves you of that responsibility of having to find an advisor who's going to help you select the investments. This advisor actually completely selects the investments for you. So these are two very popular areas. If your current advisor is neither a 321 or a 338 advisor, you may want to shop around to find somebody who is, because more liability, more responsibility is lifted from your shoulders if your advisor is that. For third-party administrators, we're finding a great acceptance with this. ERISA 316, what that is that you can empower your third-party administrator, if they are so capable, to actually do a lot of the mundane tasks that nobody really likes doing in the retirement plan, notifying participants, all those notices that we have to send out on an annual basis. The 316 third-party administrator will do that for you. They can sign your 5500 form. They can do a myriad of services that usually plan sponsors have to do. All these duties can be lifted from you if you contact a 316 administrator. So these are very powerful things that will take work and time off your table in terms of time of managing the 401k plan, and give that time back to you so you can run your business, which is at the end of the day what you really want to do. Next slide, please. This one's a little silly, but it's actually one that we find quite often. You need to ensure that you have an adequate ERISA bond. What is an ERISA bond? An ERISA bond is a fidelity bond that your property and casualty insurance agent probably sold you at one time when you opened up that 401k years ago. And the Department of Labor requires that you have basically that you cover up to 10% of the assets, 10% of the amount in your plan. So if you have $1 million in your 401k plan, 10% of that is $100,000. You need to have a fidelity bond to cover $100,000. And this fidelity bond, what it does is that it covers you against fraud or an employee of yours that might steal from the 401k plan. It's basically a protection against dishonesty. It is not a fiduciary insurance. That is not what it is. A fidelity bond is simply against fraud or theft from persons within your organization. And most of our plan sponsors have these fidelity bonds, but they're prone to becoming obsolete, out of date. So you bought a $50,000 fidelity bond, 5 years ago or 10 years ago, and then you continue to buy the same denomination year after year after year. And this is a very inexpensive insurance. It's about $100 a year. And, eventually the plan assets grow and they exceed what your fidelity coverage offers. And so, you have to confirm on an annual basis that you have the right amount. It does cap out. You don't have to have more than $500,000 worth of fidelity bond, unless, of course, you have employee stock in your plan, which I'm willing to bet that most of you don't have that. So $500,000 is the max. The price between a $500,000 fidelity bond and a $100,000 fidelity bond is almost insignificant. So if you want to buy over, go right ahead. It's not going to cost you that much, and you'll be protected for a long time. So that is the 8th best practice that we want to share with you. The 9th is compliance with 404C. 404C is not a law. It's a recommendation. It's a best practice. What is 404C? Basically, what 404C is it's a way to protect yourself against poor investment decisions of your employees. If you offer a nice retirement plan and you have a lot of different investment options, as you should, and one of your employees decides that he or she is going to put 100% of their money in, we won't say the Bitcoin fund because we're not going to offer that, but let's just say they decided to put 100% of their money in the emerging market fund. Well, emerging markets are fine, but you shouldn't probably have 100% of your dollars in the emerging market. But if one of your employees does that, are you responsible? And the law says if you're not a 404C plan, if you haven't availed yourself of 404C, you are responsible. Should they have any losses, should emerging market tank, it's possible that they could come after you. So what we do is we recommend that our employers be compliant with 404C, and it's what it requires is quite simple. To comply with it is pretty simple. You have to offer. There's 3 C's in 404C. There should have been 4, but unfortunately, there's only 3 C's. You have to give them choice, you have to give them communication, and you have to give them change. And what does that mean? It means that you need to give employees at least 3 or 4 different funds to choose from. That's not a concern. Most plans offer 10 to 15, if not 20, different funds to choose from. So you have to give them something to choose from. Number 2 is communication. You need to communicate with them. You need to tell them what these investment options are, and that compliance is fairly simple. You basically need to send out the regulatory notices, and if you do that, you'll be in compliance with that. And then last but not least, change is your plan does have to allow employees to change from one investment to another. As the economic outlook changes for the nation, they need to be able to make changes as they see interest rates rise or decline, as they see inflation come and go. They need to be able to make these changes themselves. And so your plan has to offer those 3 things in order to comply with 404C. It's a very simple reg to comply with, so you might be better served by declaring yourself a 404C company than or a retirement plan than not. So that is a very simple way to alleviate some of this liability. Okay. And finally, number 10 is use a qualified default investment alternative. What the heck is that? Well, a qualified default investment alternative is an investment or a series of investments within your plan that will accommodate any employees who do not make a proactive decision to choose their own investments. Let's take an example. 20 years ago, 30 years ago, you offered a retirement plan and you were going to do a profit sharing contribution, but the employees didn't sign up for the 401k part of the plan, but somehow because of the way that the profit sharing works, you ended up giving a contribution to them anyhow. You were forced to, by the testing and the third party administrator, to make a contribution to these employees. But they didn't make an investment election. And so back in the day, their investments would have gone to a cash account, a money market account probably of some kind, earning back then, I don't know, 3, 4, 5% maybe. But today, we all know that money markets earn 0%. And so if you have somebody who hasn't made an investment choice, it's not okay to put them in the money market account because their money is losing pace against inflation. So as a result, the industry has created these default investments that are either age appropriate or risk appropriate. And so the individual that has forgotten to choose an investment election or shows apathy towards choosing investments will be put in a program that will in fact give them an actual rate of return, either based on their age or based on some criteria that it's chosen as, as in terms of risk return. And so their monies will eventually get invested in the stock market and bonds and international and domestic, and they will end up actually having a rate of return on their investment. And so very important, if your plan doesn't have a QDIA, you probably might want to consider it, because if you don't, you are subject to some liability. If you do offer a QDIA, probably you'll want to at least analyze it and discern as to why it is that you're using that particular qualified default investment. And that is it, really. Those are our top 10 recommendations for you. If you care, we can be happy to review your retirement plan. If you're uncertain whether you're in compliance or violation with any of these rules, the retirement plan unit here at HBKS would be more than glad to review your plan for you. Just make a comment in the webinar section, and we will get back to you, in touch with you, and it would be our pleasure to help you determine that. Thank you so much, and I will turn it back to our hosts.
Thank you very much, Brian and Rod, for all of this great information. I think we've all learned a lot from everything that you guys have shared with us today. Again, Michelle, if we go forward a couple of slides, I just want to make sure that Rod and Brian's contact information appears on the screen. For those of you downloading the handouts, there's also some information about HBKS Wealth Advisors available in these slides as well. Of course, as I mentioned, you are welcome to contact Rod or Brian with any of your questions, comments, concerns, etc. Their contact information is shown, or of course, please feel free to contact Jim DeCenzo or myself. Thanks so much, everyone, for attending, and have a great day.